When markets go into correction mode, it can be difficult to feel calm and in control of your finances. But it's important to do just that for the sake of your mental health and capital preservation. Easier said than done, no doubt, but today we're going to look at one paramount way of keeping your wits about you when the bears take over. First, you must be sure to use your risk management strategies, trim your positions, and cut your losses when things head south, no exceptions. Be sure to protect your capital first and foremost. Then, once you've got that squared away, it's time to think analytically about how the market is behaving. There are different types of market corrections, and knowing which one you're in will help you be more equipped for handling the eventual market recovery. Some market corrections indicate that a recovery is further out than you think. Others, however, foretell a much quicker turnaround. But it can get tricky. Sometimes you may think you're in one type of correction when suddenly the market changes course and morphs into a different, more prolonged type of correction. One thing is for sure, hindsight is 20/20. And by studying past market corrections, IBD has been able to distill the various archetypes and how to handle them. Today we'll be discussing three key correction archetypes: the vertical violation, the three waves down, and the V-shaped recovery. First up, let's take a look at the vertical violation. A defining factor of vertical violations is the steepness of the decline coming off the market top. The number of down days aren't just slightly higher than the up days, they're substantially higher. You'd likely see several days of selling with just 1 or 2 weak attempts at a gain. At least one of the down days will stick out with a much larger drop of 3% or more. Finally, the decline doesn't just meander down to the 50-day or 200-day moving average, it slices through it with intensity. When you see this signal, you can typically expect at least a couple of months of choppy action and possibly a bear market. Here's a list of past vertical violations that investors can study. For this video, we'll pick one from this list to review, but valuable information can be gleaned from each instance. So let's go back in time to the latter part of 2018 for our example. Looking at the NASDAQ, the selling was particularly notable on October 4th with a 1.8% decline that sliced through the 50-day line. The NASDAQ composite had been somewhat range-bound prior to that. Still, this was enough for IBD to switch its market outlook to uptrend under pressure. In today's market exposure scale, that would likely equate to 40% to 60% recommended exposure. By October 10th, the chart began to look much worse. The index sliced through its 200-day moving average with a drop of 4.1%. In addition to that one very concerning day, only one of the 5 previous trading days was positive. IBD then lowered its market outlook to market incorrection, which would be a recommended exposure of 0% to 20% in today's market exposure scale. Typically, given the intense nature of the violation, investors should expect the market to take a few months to heal and a new rally to take hold again. This means your first 1 or 2 follow-through days are more failure-prone. This is exactly what happened in 2018. The vertical violation attempted recovery and failed multiple times. The correction was a vertical violation, and over the next several months, it developed the characteristics of another correction archetype, the three waves down. Oftentimes, market corrections will take the form of multiple waves of intense selling, with brief attempts at recovery in between that last a few weeks to a month or 2. The three waves down can even turn into a 4 waves down, as it did in the 2008-2009 bear market, depending on your interpretation of the action. Returning to our 2018 example, the market began to rally at the end of October. Then, on November 7th, we got a follow-through day. That happens when a major index rallies 1% or more in volume heavier than the prior session, at least 4 days into an attempted rally off lows. Things were looking good as the NASDAQ retook its 200-day line, but then 2 days later, the index closed below the low of the follow-through day. This is an early sign of failure. Soon after that, selling intensified, and we saw the second wave down in this correction. Then on November 28th, we got another rally attempt with a follow-through day. This day had a larger percentage gain, and more stocks seemed to make progress afterwards. Rather than an immediate sign of failure, the NASDAQ composite made progress to its 50-day line, then it got turned away with a dramatic 3.8% drop. That bearish action turned into a third wave down as selling intensified. After nearly 3 months of an intense stock market correction, we finally got a strong rally day off the lows on December 26th. Historical precedent hinted that this follow-through day would be the one to work out, and it did. In the months following, the market rallied over 32% through early May. A different example of a vertical violation that did not turn into a three waves down was in August 2011. On August 2nd, the Nasdaq fell 2.75% in above average volume. The index sliced through the 200-day line in a correction that ultimately deepened to 20%. A few days later, on August 9th, the index bottomed out with an upside reversal. The action that followed was similar to the correction in 1987. We saw a big devastating sell-off followed by several months of choppy action back and forth. The charts needed time to repair. Eventually, the indexes managed to recover in the first half of 2012. Markets always do resolve themselves eventually, so it's important to stay positive. But be sure to respect the trend. In choppy times, following a vertical violation, it's often smart to wait for the indexes to get back above their 200-day lines before really ramping up exposure. It can also be smart to invest in low volatility stocks and stay away from your more high-octane names. Investors should also, in the meantime, look out for bottoming signals, such as a follow-through day, intraday lows getting above the 21-day line for 3 days or more, and a tightening up of trading action. Together, these all make for bullish indications that the market is turning around for the better. Now let's take a look at another market correction archetype, the V-shaped recovery. We saw this type of action in October 2014. This did not meet the textbook definition of a vertical violation, as the number of down days did not far exceed the number of up days. Also, there was no single huge down day. On October 15th, the index managed to have an upside reversal and close near the top of its intraday range. 4 strong up days later, the index retook its 21-day and 200-day lines. By October 31st, the Nasdaq had eclipsed its prior highs and was back on the road to further gains. 2020 is another extreme example of a V-shaped recovery and is definitely worth studying. As you can see in each of these examples, investors must pay attention to what the indexes are doing around their moving averages. Retaking key levels in strong volume, coinciding with a follow-through day, offers a strong signal for investors to scale back in incrementally. It's important to note that we can't predict exactly what will happen when a market pulls back, so remain flexible. A certain type of correction could morph into another. You must be able to change your game plan as the market environment shifts. Not every correction will fit neatly into one of these correction types, but it's a good way to prepare yourself for what could happen. And always remember that having a game plan based on historical precedents can give you a huge edge with protecting your capital.